Okay, let's just jump right in. If you're self-employed, you know this feeling all too well. Your business is killing it, the money's coming in, but when you go to buy a house, the bank looks at your tax returns and suddenly you don't look so successful anymore. It's a really frustrating paradox for millions of us.
And we're not talking about a small group of people here. Over 16% of the entire workforce is self-employed. That is a huge chunk of the economy, millions of potential homebuyers who are basically running into the same exact wall.
So what gives? Why does this happen? If your business is doing great, why does getting a mortgage feel like climbing Mount Everest? Well, the answer is all about how traditional lenders are taught to see your income.
And this right here, this is the heart of the problem. On one side, you've got your tax return. You and your accountant worked hard to legally minimize your taxable income with smart deductions. But on the other side, you have your bank account, which shows the real story, your actual consistent cash flow. Traditional lenders are obsessed with the tax return. But what if there was a loan that focused on what's really happening in your bank account? So here's what we're going to cover. First, we'll dig into that entrepreneur's dilemma. Then we'll talk about the solution that focuses on cash flow. We'll show you how your real income gets calculated, who this is for, we'll bust a few common myths, and then lay out the actual path to getting one of these loans.
All right, Section 1, the entrepreneur's dilemma. I like to call it the tax return trap. See, here's the problem. All those smart business moves you make to lower your tax bill, deducting equipment, marketing, travel, they do their job, but they also crush the income you can show to a mortgage lender. You literally get trapped by your own financial savvy.
But there is a solution. There's a type of loan designed from the ground up to see your real financial success. The success that's plain as day in your bank account, not buried in tax forms. And that brings us to the hero of our story, the bank statement loan. It's pretty simple, really. It's a mortgage that verifies your income by looking at 12 to 24 months of your bank deposits. It just completely sidesteps the tax return trap by focusing on the cash you actually have coming in.
Okay, so how does this magic actually work? How do lenders take a year's worth of deposits and turn that into one single number they can use to approve you for a mortgage? Let's get into the mechanics.
It's really just a three-step process. First, they analyze 12 to 24 months of your bank statements, all in a row. Second, and this is the key part, they apply what's called an expense factor. Now, this isn't just some random number. It's a percentage based on the typical overhead for your industry. So a freelance writer might have a pretty low expense factor, but a restaurant owner would have a higher one. Makes sense, right? And finally, they take what's left over from your deposits, and that becomes your qualifying income. Let's make this real with an example. Meet Sarah, a restaurant owner. Her tax return, after all her deductions, shows she makes only $40,000 a year. Not great for getting a mortgage. But her bank statements, they show she's depositing $8,000 a month. The lender applies a 30% expense factor for her industry, which leaves 70% of her deposits as income. You do the math and, bam, her qualifying income jumps to over $67,000 a year. That is a total game changer. Now you might be thinking, okay, that's great for Sarah, but is this for me? Well, this is a powerful tool for a huge slice of today's workforce. Let's take a look at who can really benefit here. I mean, the list is pretty broad. You've got your business owners, of course, but it's also perfect for freelancers and gig workers. Think writers, designers, Uber drivers. Real estate investors can use it to show rental income directly. It's a lifeline for 1099 contractors and even ITIN borrowers who might not have that traditional credit history but have a super consistent cash flow. And what's really cool is the flexibility. It doesn't have to be all or nothing. Let's say you have a regular 9-to-5 job with a W-2, but you also have a killer side hustle. Lenders can actually combine your W-2 income with the income from your side business analyzed through your bank statements. It's a hybrid approach that gives a full, honest picture of what you're really earning. Okay, whenever you talk about loans that aren't, the standard vanilla mortgage, a few myths always seem to pop up. So let's just get ahead of those right now and bust some of the most common ones. The first thing you always hear is this one. Oh, the interest rates are going to be through the roof. It's not even worth it. So here's the reality check. Yeah, the rates can be a little bit higher than a conventional loan, but that gap has gotten so much smaller over the last few years. There's way more competition now, and for a lot of entrepreneurs, paying a slightly higher rate is a tiny price for the ability to actually qualify for the home they want and deserve. All right, myth number 2 is all about the down payment. People just assume you're going to need like 30 or 40% down to get one of these loans. Nope, that's just not true anymore.
lenders can now offer financing for up to 90% of the home's value. That means you could get in the door with as little as 10% down. I mean, that's really competitive, sometimes even better than what's needed for other big loans.
Okay, so we've busted the myths, you're intrigued. What does the path to actually getting a bank statement loan look like? Let's walk through the key steps and what you really need to think about. First up, what do you need to pull together? Well, the big one, obviously, is 12 to 24 months of your bank statements, all in a row. No gaps. Beyond that, you'll need any business licenses you have, and then the standard stuff like your ID and proof of assets that you'd need for any mortgage.
Now, here's a little pro tip for you. Be prepared for the timeline. Because a real person is manually going through all your deposits, the process can be a bit more detailed than for a normal W-2 loan. So just do yourself a favor and build a little extra buffer time into your home buying schedule.
And finally, credit scores. You might think you need a perfect 800 score for a loan like this, but that's not the case. While yeah, a higher score always gets you a better rate, these programs are pretty flexible. You can actually find approvals for scores starting around 620, which opens the door for a whole lot more people than just prime borrowers.
So it all comes back to this. For years, your tax return was the only key lenders would accept. But for the modern entrepreneur, for the gig worker, that key just doesn't fit the lock anymore. So the question I want to leave you with is this. Could the real story of your success, the one told every single month in your bank statements, be the key that finally unlocks the door to your next home?